Imagine this. The world's markets are soaring. Valuations are stretching toward the sky, and every headline seems to scream, "This time is different." Then, on the horizon of 2026, something shifts. It's not a total collapse, not yet, but a pivot. A sharp correction, a wave of panic, a tsunami of fear sweeping through the global financial system. And while the media scrambles to find survivors in the wreckage, you're already moving. Why? Because you know a secret that most people do not. Every market crash carries within it the seeds of an incredible opportunity. What if the crash that many analysts are whispering about for 2026 is not the end of your financial journey, but the very moment that could make you wealthy? It sounds counterintuitive, I know. But today, we're going to walk through exactly how that works and how you can position yourself right now so that you're not a victim of the crash, but a beneficiary. Let's be clear, the setup is already in motion. We're seeing valuations at levels that are giving experienced investors déjà vu. The S&P 500 is currently trading at one of its richest valuations since the dot-com bubble. The excitement around artificial intelligence and other groundbreaking technologies is running wild, pushing some stocks to astronomical heights. At the same time, there are warning signs on the dashboard. Global economic growth is showing signs of slowing down, government and corporate debt levels are mounting, and central banks are starting to run out of the easy money tools they've relied on for years. To put it simply, the conditions for a major market adjustment are not just present, they're brewing. But for someone who is paying attention, this isn't a reason to panic, it's a reason to prepare. First, let's understand the fundamental reason why a crash can create millionaires. During a sharp market drawdown, assets that were once ridiculously expensive suddenly become cheap. Fear becomes the dominant emotion, forcing people to sell indiscriminately. Confidence evaporates. Capital flees from anything perceived as risky and piles into so-called safe assets. But when the smoke clears, those who have two things, cash and clarity, get to buy the best assets at the worst prices. From the ashes of panic, incredible value emerges. Great companies, prime real estate, and game-changing ideas all go on sale when nobody else wants them. And if you have the courage to buy the right ones, your payoff comes when the green shoots of the next recovery begin to sprout. So how could this play out in 2026? Let's outline 3 concrete steps you can start thinking about today. And I have to say this, none of this is a guarantee, only a possibility. This is about preparation, not prediction. Step 1 is to identify the assets that are most likely to get hit hard. When a bubble bursts, it rarely takes down just the weak stocks or obscure sectors. Historically, the pain starts with over-leveraged corporations, companies with stretched valuations, and sectors that are heavily dependent on pure momentum and hype. Today, that could point to certain tech companies with sky-high growth expectations that they can't possibly meet, speculative assets with little to no actual earnings, or industries burdened by massive debt. By recognizing where the greatest risks lie, you can start to lighten your holdings in those areas or hedge your portfolio ahead of time. Step 2 is to prepare your liquidity. This is the most crucial part. It is incredibly difficult to buy when every chart is a sea of red unless you have cash ready to deploy. During a crash, selling into the panic is the worst possible move. Buying into it is the smart move. You need to have dry powder ready. That might mean reducing positions you expect to suffer the most, increasing your holdings in cash or cash-like assets, and having a dedicated stash of capital that you are mentally prepared to deploy when fear is at its peak. Step 3 is to have a plan for what you will buy after the crash. The time to decide which assets you want to own for the long term is when the market is in a free fall and your emotions are running high. The time is now. Think about high-quality companies with strong balance sheets and durable competitive advantages. Think about real estate in structurally strong locations with growing populations. Or even consider sectors that thrive in reset environments, like distressed credit or turnaround opportunities. These will all become available at a significant discount when the crowd is desperately running for the exits. Let's walk through a hypothetical scenario. Let's say the market, driven by relentless enthusiasm for AI and electric vehicles, enters 2026 with already stretched valuations. We're already seeing some institutional investors warn of a coming correction, even while retail investors continue to pour money into ETFs, chasing the highs. Then, some trigger event occurs. It could be a disappointing earnings season from a few tech giants, a policy misstep by a central bank, or an unexpected geopolitical shock. Suddenly, the momentum that drove everything up reverses course. The most popular tech stocks fall 30, 40, or even 50%. A hiccup in the credit market causes a ripple effect through heavily indebted companies. The dollar rallies, liquidity tightens, and the panic selling begins, spreading across the entire market. Now, if you've prepared, this is your moment. While others are panic selling, you step in with your cash reserves. You start buying shares of the strong, resilient companies that have been unfairly punished in the sell-off. You might buy bonds of financially sound firms at discounted prices. You could even scoop up undervalued real estate as others are forced to sell. Over the next few months and years, as the market inevitably finds its footing and begins to recover, valuations normalize. High-quality assets rebound first and fastest. And you, the prepared investor, are on the beautiful side of that move, watching your portfolio grow while others are just starting to recover their losses. Of course, it's important to be realistic. Opportunity doesn't guarantee reward. Market crashes can lead to bankruptcies, and some assets may never recover their former highs. That's why you must be selective. You have to approach this with a value investor's mindset. Look for businesses or assets that have the strength to not just survive the crash, but to emerge even stronger on the other side. Think of the investors who bravely bought bank stocks in the depths of 2008, or the contrarians who bought battered travel and airline stocks in the spring of 2020. The same principle applies here, and remember to think beyond just stocks. A major crash could affect real estate, commodity markets, and private assets. The Financial Stability Board recently warned that global asset valuations are misaligned and market vulnerabilities are elevated. If commodity prices fall, as some projections suggest, it could trigger a domino effect across resource companies, emerging market debt, and the banks that lend to them. This means you could find opportunities not just in stocks, but in distressed corporate debt, in overlooked value stocks, or even in traditional safe havens like gold or other real assets. So, how could you structure your portfolio to ride, not suffer, the crash? First, allocate a portion of your capital to defensive assets right now. This could be high-quality bonds, cash equivalents, or perhaps a bit of gold. This not only protects your capital, but also lowers the psychological stress of a downturn. Second, create a buy list of 3 to 5 high-quality investments that you would love to own at the right price. Decide in advance that you will only purchase them if they drop by a specific amount, say 30% or 40% from their current levels. Third, consider reducing your exposure to the most speculative assets with weak fundamentals. As the saying goes, when the tide goes out, you find out who's been swimming naked. So why are we talking about this now? Because the crowd still believes in a one-way ticket to continuous growth. When that faith inevitably breaks, the element of surprise will amplify the downward move. I recently read an article where an analyst predicted the S&P 500 could reach 9,000 by the end of 2026, but in the same breath called the current environment a big, beautiful bubble. When that kind of optimism is priced in, any missing piece of the puzzle, be it earnings, growth, or policy, could trigger a very sharp payback. The more people expect the market to soar, the more vulnerable it becomes. So, what does this all mean for you in practical terms? Decide now what you would buy in a crash. Write it down. Maintain or build your liquidity so you can act when fear is universal. And most importantly, keep your mindset flexible. You're not trying to predict the exact date of a crash. You're preparing to act decisively when it happens. Embrace contrarian thinking. A market crash in 2026 is not just a threat. It could be your defining moment. If you prepare, and if you hold the courage to act when others are fleeing, you may find yourself on the right side of financial history. Wealth is less about avoiding chaos and more about navigating it. The crash that terrifies the many can create a fortune for the few if they're ready. Thanks for watching. If you found this perspective valuable, please consider liking this video and subscribing to the channel for more content to help you navigate the markets. See you in the next one.